Well, the truth is, he's actually selling some of his share portfolio, namely his monster Apple position, to specifically put more money into bonds.
But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world, we find it quite attractive.
And in reality, that cash he talks about is actually held in Treasury bonds. So when he says he doesn't mind building the cash position, he really means building the pile of short-term US Treasuries. As you can see, in the most recent quarter versus the same quarter 12 months ago, it actually has Berkshire's cash position reasonably even. But as you can see, Buffett has reduced the stock portfolio and sits that extra cash in short-term US Treasuries that have grown quite substantially. So that's really the first thing we can take away from Buffett's actions over the past 12 months. In these higher interest rate environments, when things seem reasonably shaky around the world and uncertainty rules the day, don't forget about bonds.
We've had 125 billion or so in very short-term investments, and believe it or not that long ago, we were getting 4 basis points, which is next to nothing on that 125 billion, which means we were getting 50 million a year. And now the same money the other day or day before yesterday, we actually bought 3 billion of bills at a 5.92 bond equivalent yield. So we will have what produced us not that long ago on a 12-month basis was producing 50 million a year, producing something in the area of 5 billion a year. So
sure, they're nothing spectacular, they're not flashy or interesting, but they do serve a purpose, particularly when everywhere you look, valuations on any sort of decent businesses just sit at sky-high levels. And that actually leads us straight into the second big problem investors face in 2025,